Hey guys, look, this one isn't really to, I guess, kind of diss ICT. It isn't to kind of big him up either, really. I think I get asked a lot of the time, right, in terms of the smart money concept. So whether you like him or you don't, whether you believe in the system or you don't, right? I know a lot of people are, searching for, using, have used a lot of these types of concepts, right? So if you're obviously a follower, from what I've seen, there's a lot of noise to kind of get to some useful information. And if obviously you don't like what you've seen, it's probably again to do with the noise, right? So what I want to do is just kind of, I guess, cut through that in as quick as way of any way I can, in terms of just showing some of these kind of concepts, right? And just kind of simplifying them, right? So I managed to find this off the internet just now, and obviously some of these terminology, some of these things, they're pretty, pretty obvious, I guess. Right now, they're not so obvious if you're a newer trader, and you're not really understanding the market dynamic itself. Now, obviously, some of the tools like COT, I use the COT data quite a lot. This is a very good indication in terms of market sentiment, what the bigger players are actually doing. I see a couple of these abbreviations, right, that obviously fit larger money. So I guess the idea of smart money is, where that actually comes from, where that stems from. Now, understanding how smart money works and why smart money works, right, is something you can do pretty straightforward, right? You go back to Dow theory. Dow theory has, kind of 6 bullet points in terms of what the key premise of all of the market structure is, why it does what it does. When indices kind of confirm they work with each other, the trend is kind of trending until the end. You got three time frames and three types of trends overall. So I see this AMD, this obviously accumulation, manipulation, distribution. Now, the accumulation, Wyckoff called this the markup, right, which was where the manipulation comes in. And that, technique, that's over 100 years old, right? The power of three, I'm guessing, again, stem from, the Dow, again, 100 years old, right? So a lot of these things, equal high, equal lows, these are not things you invent, right? These are just kind of terms you use for a certain technique. Previous day high, I mean, these things obviously self-explanatory. Um, stop hunt. I mean, stop hunt. There's a term called sweep. Sweeping the market. It's almost sweeping something under the rug. It's that kind of concept, right? Order blocks. I mean, this is something I guess is again terminology, something that makes sense when you understand what's actually happening within it. And I'll explain this kind of, again, very simply in a second. Fair value gaps, these can also be called imbalances. These are just kind of big areas where prices travel through very fast. Liquidity pools, again, sitting underneath areas of interest, right? Again, you can see these from using volume profiles, for example. And the institutional order flow. And this comes back to order blocks. This comes back to the kind of efficiency slash inefficiency in the market, right? So just to kind of cut through all that, right? Now, what I'll do is I'll just hide that in case I want to use this again or I want to share this. So if you look at the market, right, clear as day, you've got some kind of moves down here, right, that obviously push the market up. And then you've got some moves up there that push the market down, right? So if you want to get into the nitty gritties, the last candle to the upside, there's going to be an awful lot of sellers, right, fighting against the momentum. Clearly, the momentum was up, right? So the general idea is you can classify this as some kind of order block, right? Now, again, there might be a little bit more detail in terms of what ICT wants to go into, and you can spend the next 6 months trying to learn that. But in the general sense, if you understand that lots of sellers stepped into the market, price rejected from this kind of area of interest for the future, right? Similar thing, ultimately down low, right? I'm going to just copy this over there. The last major selling candle, right, before the move up. Now, there's going to be a couple sitting in there, right? Let's do this one before the very last low, right? I can obviously magnetize that as well and get a general idea. And what you'll see is, price ultimately moves away, comes straight back based on the news, looking at this one candle, and then rejects, kind of pushes itself away, which means there was an awful lot of buying interest in there, right? Which means this in the future will inevitably be an area of interest for buyers to push to and from, right? However, this is where the liquidity pots come in. This is where, money is kind of sitting here, because you're going to have stop losses sitting underneath these levels as well, right? So just because the price rejected from something like this, it doesn't mean that in the future we couldn't rally on up, sweep the level, and then ultimately sweep back down, right? Now, in Wyckoff terms, you could class this as a UT, which is basically the first sweep. Then you come into the UTAD, right, which is ultimately the second sweep, and it's the sweep of the sweep, right? Now, you're going to see a lot of this type of movement, especially in something like euro dollar. You're going to see this movement, from my point of view, from a GMT perspective. I'm obviously living in France. I look at still, UK markets, and GMT 8 o'clock, or French time 9 o'clock AM, the market ultimately has just finished off the back of the Asian session. Now, there's a lot of liquidity, under and above that session. So you're going to get these sweeps of the market in and around that time. You're also going to see liquidity when you have markets that ascend or descend down, and then you get the kind of counter liquidity in the inverse, right? So again, putting all these kind of pieces together, and I know I'm trying to kind of rush through this because it's just kind of giving you everything almost in as quick a time as physically possible, right? So in the grand scheme of things, when we look at everything that's going on, we've got clear logic as to why, right? There's stop losses sitting there. There's new orders to take it short, right? There's all sorts of things happening behind this. And the fact that we've rejected first time round means that if the larger operators are buying from these levels, they're also going to be buying as we come back in, because they're going to be protecting their position the first time round, right? As the markup comes in, you're then going to see the first signs of distribution, right? Now, this isn't complete and utter distribution. What's actually happening here is the larger players are taking partial profits, right? So in an Elliott wave move, what you're seeing is a 0 to 1, 1 back down to 2, up for a 3, down for a 4, completion 5, right? And you can start to see how these things kind of piece together. So again, when you think of the logic behind each and every one of these moves, right? Now, the next thing that we can look at is, why did the market stop and reject and turn here? Well, if we look across to the left, right, I'm going to swap this arrow around the other way. This is what I've seen ICT traders refer to as a fair value gap, right? This is basically an imbalance in the price. What this basically means is that as the price dropped here, the momentum grew so fast, we didn't really get enough of a situation that buyers could step in and pick up the orders at those levels, right? So if buyers kind of failed to pick up the orders at these levels, we ultimately push down harder, right? Now, at this particular point, what you have to realize is that when the price comes back to these kinds of levels, the sellers that caused this momentum are going to be fighting fiercely, right, to ultimately protect those positions. And again, it's kind of as simple as that, right? So there's nothing really fancy, there's nothing really technical. You just have to understand the logic for why the move is the move, right? Now, another thing you can do is, if you were to stick on the volume profile, right? So we're going to come from this swing low up to the swing high, and we're going to see what's actually going on behind the scenes, right? Now, if you know nothing about volume, right, the top line is the value area, right? The bottom line is the bottom of the value area. This red line is the point of control, and all that means is where the biggest volume in that swing occurred, right? So in theory, all of this area here, right, something was happening inside of that for the price to ultimately push up. Okay. Now, if we take that value area, we can do a couple of things. We can say, well, how does the price react when the price comes back to value area? Well, at this particular point, we're seeing the first level of distribution followed by a redistribution. Then we come back into the same kind of value area, creating almost a bigger volume profile now next swing. Right? Now, you can obviously put things like volume profile on visible range, which means you can have the whole screen and it'll count the volume from this candle all the way across to this candle. You can have fixed range volume, which is what I tend to use more, which is swing by swing. You can do this candle by candle if you really wish. So understanding what the volume's doing, right? A lot of the volume is sitting here. As we start to rally, the volume falls off. The volume falls off, which is ultimately the rejection for the move back down. Okay. We then come back down to this level. Now, what did I say? Right? What did I say earlier about the stop losses? Right? What actually happens is the larger players have done the bulk of their selling. They are now in the distribution phase, right? And at this particular point, what they're doing here is taking the stop losses from anybody else that was buying at these levels, right? Grabbing liquidity. This is the run on liquidity, okay? So again, from a smart money perspective, right, there's lots of other, little details and lots of other little nuances, lots of little terminologies that we can kind of spin into this. But if we understand that the seller stepped in, right, we got buyers down at this level, we've taken stop losses, right, potentially added even short orders at this as a position, right? We then get quite a strong rejection from this bottom, right, which is a big push to the upside, right? Very thin volume here, right, which means it didn't take a lot of money in terms of keeping that as a situation, right? Keeping this position above these highs, right? So with all that being said, the value area, which is now going to act as the next magnet, is going to show where the high volume nodes are. So from here to here, right? The high volume node is clearly up here, which will be acting, like I said, as a big magnet. Right? We then have this particular node, which if I put a spike from the center of that one there, right, you can see that price comes up and rejects. Right? So this is where the sellers are currently, I guess, kind of guarding their position. Right? So what we have now is basically a range until we don't. Okay, and that range until we don't is basically saying, from an institutional money flow point of view, you've got a premium versus a discount range. When the price is above halfway of the range, the chances are the larger players will be distributing. Right? They might still have some profits that they want to take care of from this move. And when the price is below this level, these guys / similar type players in the field, this is where leverage funds from the COT point of view comes in. Right? These guys will be buying at the discount. So you got premium selling, discount buying, right? And this is how the market works over and over and over and over again. And what you can do is you can draw the same kind of box, the same kind of levels, this kind of level up here, right? You can get into the detail in terms of the gap is formed after this classifies as an order block and all that kind of stuff. But in the grand scheme of things, all we want to be seeing is what's going on when we have these rejections from these levels. Right? Now, if you want to go one step further, one step deeper, the videos that I've been doing over the last week or so in terms of the mechanical trading, the trend, right, and this goes back to the Dow theory, the trend is your friend until the absolute end, right? And if you think like this, having a daily time frame, having say a 4-hour time frame, a 1-hour time frame, you can change that 1 hour down to a 15-minute if you want as a trigger. But if all three trends are in the same direction, follow the trend. If two of the three and two of the bigger trends are in the same direction, you can be looking for the pullback on the third. Once you then get a change of character, right? So again, this is another abbreviation, right? This is the CHOC, and the CHOC ultimately change of character basically means when the price is being, say, trending down, right? We then get a move up and a move back down. This low has failed to take this low. And then we come up and we actually close above the prior high, right? It's that line there, that's our change of character. Now, the difference between a change of character and a break of structure is, again, very straightforward in terms of explaining. Once you actually come up, down, up, right? The break of structure happens more or less there, right? But only after we've changed the character, because we were in a downtrend, we are now in an uptrend, right? At this particular point, we drop down. You can see on a smaller time frame, we come back up, drop down again. That changes the character. So we've changed the character now to the downside. So in theory, if I was doing any kind of count, I'd be looking at, we're currently in a downtrend, whatever time frame, 15-minute, we're on right now, right? So again, very straightforward, very simplistic, easy to understand, right? And when you put it all together, the volume ultimately confirms the overall big picture. The volume and the way that the price behaves around that volume. Lack of volume, right, in terms of one side, or it being one-sided in terms of the buying or the selling at that particular point, will inevitably create a gap. The gap will end, right, and then you come into an area of interest. That area of interest, I classify these as an auction area. The auction area will give you a buy or a sell as a rejection away. You can see things like the master pattern, for example. You get expansions, and then that expansion takes you into overall your trending phase, right? So you can see how all the market kind of overlaps and kind of pieces together, comes together. All right. So I'm going to finish this one as it is. Obviously, go and watch the mechanical videos if you want more in depth in terms of how the liquidity flows. But in the grand scheme of things, I hope you enjoy.